Ladies and gentlemen, next up to bat in our series of our trader segments here, where we give you an introduction to our trading team, or at least a reintroduction, and that means Blue Chip Trader Scott Smith is going to be up to give us a little background and a little insight into what makes him a good trader. So, Scott, I will give you the floor. Why don't you give us a brief introduction to your background?
Hey, Jim. Hey. Quick background. I've been doing this for about, just over 20 years now. I stopped counting after 20. But I started off in the mid to late 90s working down on the floor of the New York Stock Exchange with a bunch of specialists, acting as a clerk for a while. And then I eventually, with the NASDAQ bubble taking off, in the later half of the 90s, 98, 99, I was fortunate enough to get my way upstairs and to be on order desks and working alongside market makers for a lot of the NASDAQ internet bubble that was going on out there. So I got to learn that whole side of the business as well, a little bit of sales side as well. And then things kind of just, obviously people probably know from market studies and history, things went sour during 2001, 2002. And that was really kind of the wake-up call for me, where I realized the market just doesn't constantly go up. You know, you look at a few charts over the 90s, everything was always in a massive uptrend. And then that was my first real experience of a significant correction in the market, and I realized that fundamentals weren't really going to cut it, and carry you through, the short-term aspects of trading, because everybody saw value in stocks as they were plunging, and the sentiment was still bullish that whole way down, surprisingly. And I eventually, fell into talking to the right crowd and to certain people, and it didn't become just about order flow. It became more about, looking at support and resistance levels, looking at trends, looking at momentum and moving averages. And I really just kind of fell in love with technical analysis because it seemed to have explained a lot of the supply and the demand that was out there for a stock on multiple time frames. And from there, I just kind of dove right in, got my CMT license over the years. That's the Chartered Market Technician. And just went full all in, just using technical analysis, less fundamental over the years. By the way, I do have an accounting background, so I do actually know how to read all the income statements and balance sheets. I just choose to ignore them for the most part. But again, I just kind of made this whole transition and shift from fundamental analysis to technical analysis. And it's been really kind of my go-to bread and butter consistently for years. It's been trial and error. I'm not going to say it was an easy journey by any means. It took a long time. I actually blew up probably I wouldn't say blow up completely, but when you lose more than 50% of your account, that's not fun. So I don't know if that constitutes a blow up or not. But yeah, there's definitely a trial and error period. But fortunately, the last 15 years or so, I've been consistently profitable. I managed to become more disciplined. I managed to figure out how to control risk instead of looking just for reward. And I think that was really kind of the major turning point where I think I went from just kind of gambling, speculating into what I thought the market was going to do and where I thought it should go. When I made that shift to just saying, hey, this is what's happening and here's the risk level, and I'm just going to let it ride, and as long as it doesn't get past my risk level and I keep that under control, well, then the profit should just continue to work in my favor. And once I made that whole outlook transition, things just started really kind of coming into place, bigger picture wise, and just been really good the last decades or two. So that's where I sit for now. Basically, for a style-wise, I've kind of adapted this hybrid sort of day trading, swing trading type of thing. And what I mean by that is I put a trade on, and I don't like to carry losses overnight. So when it comes to risk management and controlling my losses. I'm a day trader. I just don't carry losses overnight. The only rare exception will be if I actually have the intention of scaling into a price zone on a stock. Typically when I trade something that's very high price, like an Amazon, a Google, the daily range in those things are so wild that you have to almost take a quarter size position or a third size position around almost 5 to 10 points of a price zone to get a position on. So sometimes it warrants carrying a little bit of a loss overnight on a small position with the intent to, get in the next day or so. But generally speaking, on most trades, I do not like to hold losses overnight because I like to sleep at night. I don't like to be concerned and up all night and saying my prayers at night that the stock's not going to gap against me come the morning. So I tend to just cut those losses pretty quickly throughout the day if it's not working in my favor. On the flip side of that, I am a swing trader. I will hold a position for as long as possible, for as many days, weeks, or months possible. Now, of course, I'm taking profits along the way. I am a big fan of trimming and trailing on positions that move into your favor, usually at multiple point increments based upon the initial risk on a trade. So if I risk $2 on a trade, if it goes up $2, I trim a little. If it goes up another $2 for a 4-point gain, I trim a little more. $6, I trim a little bit more. So I tend to trim and trail based upon whatever that initial, $1, $2, $3, $5 risk is on a trade. And that's worked really well for me. It's kind of kept me with the momentum. It's kept me with the move, and it's served me well over the years. It fits into that whole concept of letting your winners ride and keeping your losses pretty tight and under control as best as you can. And that's pretty much where I stand for my overall approach to the markets in a nutshell.
All right, Scott, why don't we move into a few examples that really articulate your style and give a good sense of how you come up with these ideas and how you profit from them.
Yeah, that's great. So I do a lot here at Briefing on the technical side. I have multiple columns and pages that I have to update. So I get a lot of my ideas from different scans and different lists that we have, focus lists that we have. We have a series of focus lists, actually. The Liquid Momentum Focus List, which is a guideline for people who are interested in the most liquid, strongest, larger cap names in the market on a relative strength basis. And this is really one of my go-to lists. It represents the institutional leaders in the market, and I pay very close attention to these and how they're behaving. I don't always trade them all. Sometimes I'm not always excited about the setups I see there. However, I do like to see how they're behaving in the market because they are considered to be the big money institutional type of leadership. So if they're breaking down below prior support levels or cracking below 50-day moving averages, that's kind of a warning sign that leadership isn't really there. They also usually group together in sectors and industries, so you can typically get a sense of what sectors and industries are really sort of dominating the price action there. The Emerging Growth Focus List, that's another one. Those are a little bit more small to mid-cap oriented names. These up-and-coming fundamental stories are usually there. A little bit more risk associated with them because they're still trying to prove themselves. But a lot of those names are really just more suited towards an intermediate term type of investor. And then we have the value focus list and the yield focus list, which is usually some sort of dividend yield play or some sort of a relatively cheap stock that's been showing relative strength lately for value. So there's always different components, and there's a lot of familiar names on these lists that I just seem to be really good trading vehicles overall. Nice liquidity, nice volatility, nothing too outrageous or too out of control. I also do a swing trader page, I do the TA page scans, and I also do the daily technical take, which is more of an intermarket analysis and a general broader look at everything. Combine all those together, and somehow it makes sense in my mind, and it kind of just develops a whole story for me. And in combination with reading some commentary on the site and listening to trader audio, it gives me a whole big sense of how the market's swaying sentiment-wise, how the market's leaning industry, certain sectors, industry-wise, etc. And I just somehow go through the charts, in these sectors, whether ETFs or whether individual names, and try to look for the patterns that kind of play into that whole narrative. And that's basically it in a nutshell. So for some recent examples, not to keep this dragging on too long here, lately I had Solar Edge Technologies as a swing long. That's SEDG, SEDG. You can see it on the screen there. And just a quick walk up to walk people through it. This is a leading solar name. I think anybody on Trader Audio for this year has heard me say that the TAN, T-A-N ETF, it has been one of the strongest year-to-date outperformers for the first half of the year, and I was favoring a lot of those names. I think ENPH was also a emerging growth focused list that really just took off there during the summer to the upside. Solar Edge I traded a few times. I know Gavin's traded First Solar a couple times. It's just this whole space was just really strong. And if you just look at the chart patterns here on SEDG, you can see that after a gap up back in August, which was most likely in response to earnings, price action, it just kind of went sideways there for a couple weeks. It did challenge the 50-day moving average in September on that pullback and rallied strongly back to the highs, back to those August highs there in September, and then started to pull back a little bit and consolidate, and it almost started to develop what some would call an ascending triangle pattern off that September and early October low off the 50-day moving average. And if you know anything about technical analysis, even if it's the most minuscule thing, it's usually to watch the 50-day moving average. There's just there's just magic about it that basically says price action above a rising 50-day moving average is bullish and below it is bearish. And if you just stick to that general rule when it comes to TA, you're probably going to be on the right side of a trade more often than not. And usually when you see it bounce off the 50-day moving average, that green line there, one or two times successfully, that's not just your mom and pop traders going after it. It's probably some hedge fund or institution, somebody with a lot of money is in there defending those levels. So on the TA page scans on October 18th, just about a week ago, it showed up as SEDG showed up on the TA scans under the 50-day alert. So that just kind of drew my attention to it because I knew this is a name that I like to trade. It does have a fairly high average true range, which kind of gives you that sense of volatility that can be in the stock. So it kind of gives you the concept of how much you should be risking, or how much you should be risking on the trade. Basically, what kind of position size you should be taking. So the average true range on the stock at that time was somewhere around just around $4. I usually try to round up for the sake of simplicity and for the sake of just being a little bit more conservative. So with ATR, I rounded it up to about $4 in the trade, and you can just technical analysis, Japanese candlestick analysis, whatever it is that you want to use. There was just basically this pullback to the 50-day moving average with these two doji patterns, and when I started to notice that bids were coming back into the stock a day later, I figured, all right, you know what, this is looking pretty good, and it's getting back above a higher high. It's got support at the 50-day moving average. We'll take a shot on the long side here. So we got long right in the upper 85, right around the $86 area, and for a swing trade, and we put about a $4 risk on it, which put it back near that recent low. And then it's just a matter of sitting and waiting. The price action didn't really go against us at any point, so it's just really, there was no reason to panic out of it. The initial target was to close that gap off the high about a week ago. It did close the gap, so we locked in a nice little partial profit, and then the rest is basically gravy. You just kind of raise your balance stops up towards break even, and we were fortunate enough to have this 2-day move here for another what is that, about 8 points, 10 points total. So it's just kind of this nice trailing balance on the remainder of a trade here. This is just a classic technical analysis book. I know this is like almost a textbook perfect example, but it doesn't really get any easier than this trade here. If we go to the next example, I think it's Lululemon, unless I put Jim to sleep already.
Nope, it's right up there.
All right, cool. So Lululemon, Again, this one showed up in the liquid momentum focus list. This was an earnings mover back in early September, that big gap there. So I wasn't really, and I'm not too keen on trading stocks into earnings. Usually there's this big dynamic shift going on, supply and demand wise. But this one here, I just kind of kept my eye on. It kept showing up on the liquid momentum focus list as one of these big institutional leaders. And it didn't really do a whole lot there into the latter half of September. Early October, probed those 50-day moving averages, which set it off on the TA scans on October 3rd there. So I just kind of looked at it, looked to the left. I said, okay, close the earnings gap there. And it's holding the 50-day moving average. I'll just keep it on my radar here. You know, it's a retail apparel stock. It's not the strongest sector at that time, but this is obviously a leader up trading up near all-time highs. So I got to keep it on the radar. 3-4 days later, boom, this thing just takes off above that 194, 195 resistance area, and come the afternoon, it's still maintaining that strength. I decided to jump in with a swing long right around that 196, 195 area. The ATR on it at that time was just underneath 5, so you had to risk $5. It's a $195 stock. You know, the volatility is there, and that's the key thing here. You can't just buy these higher priced stocks and risk $1 or $2. Your timing, it just has to be absolutely impeccable to do that, and it's a very difficult thing to do. So you had to risk at least $5 on this. Fortunately, the next day it just shows strong follow through, getting up to 200. In my mind, that's a $5 gain that warranted taking a partial profit, moving balance stops up to break even, and then it just went back up to all-time highs there for a extending gains to as much as $13. On the trades there, so another nice winner there. On a side note, I do trade options depending on the spreads of the stock that I see, and if I feel like there's a better opportunity there. Sometimes I'll go out and just buy the straight calls if the technicals are there. Sometimes I'll sell the out of the money puts if I think I need more time. So there's different strategies. You can always approach these, but generally speaking, I am trying to time things within a day or two to work out quickly in my favor. So you can kind of just, if you are an options trader, approach it any way you want, whether it's a covered call or some sort of diagonal spread or whatnot. I'm trying not to get too much into that onto the site because it can get a little sloppy, especially if you start rolling over options. But generally speaking, these are usually optionable stocks that I go after as well, based upon their liquidity and whatnot. The next example, I do short stocks from time to time, and I believe it's going to be Pinterest, P-I-N-S. This was a recent IPO, and I usually am not particularly a fan of IPOs. I feel like they're always usually overhyped to some degree, and when they start to falter and roll over, I'm not a big fan of it, especially after their 50-day moving average starts to come into calculation, because that's like, traders really didn't have much to go off of the first couple of weeks, and then all of a sudden, after 3 months, the 50-day moving averages show up. Some of these indicators start getting calculated on the screens and whatnot. So there's a tendency for them to react really well initially to when these things start coming about. So Pinterest cracked back underneath the 50-day moving average in September, carved out what you can call it a bearish flag, a bearish pennant, but basically had pretty strong resistance right there in that $30 area, right underneath the 50-day moving average. Started showing up on the TA scans as a pullback short candidate. The following day you had a doji type of session, and then it just started rolling over and breaking down late September with the broader market there. So we jumped on board a short. It was a little late. It was in the afternoon, and it was kind of in the lower end of the range. So from a day trading perspective, it felt like it was almost a little bit too much there, because we did have to jump in around the low 28s of that day, and we had a risk about $3, which would have been the high back up at near 31 and back above the 50-day moving average. But fortunately, it closed weak, closed poor. The next day, it just plunged down to fresh September lows, and over the course of the next few weeks, we're just riding it below that blue line, which is the 20-day moving average, for about a 4-point gain. I made about 50% on the October 35 puts at that time. So yeah, it's just kind of sitting there, right, relatively weak below the 20-day moving average. I have a very small balance left. The company's scheduled to report earnings, I believe, the 31st, is it? Let me just check our archives quick. Usually when you check our archives, you see the earnings data right at the top of the screen there. Yeah, October 31st next week. So, I've already locked in a big chunk of profits on this one, so I might just carry it, into earnings, because the stock would really have to just start squeezing and gapping up well above, my break, probably about $31 to even start eating into the gains that I had. So we'll see how it plays out. I might just bail ahead of time early, because I know the fundamental story is there and it has a very high short interest. So those are usually good enough reasons to take your profits and step aside into earnings and whatnot to avoid a squeeze. I'll deal with that next week. But yeah, that's basically it. I try to do everything as simple as possible on a swing trading basis. However, when it comes to losses, I'm more of a day trader. I really don't like losses. I keep them really tight, and I think that's one thing you have to understand. Even if you're following our trades here on this service, you have to, be pretty disciplined to take a lot of losses. When we put out our risk levels and we say we're scaling into it, you should be concerned. So these final two charts here, I just want to highlight that, I always hate webinars where people don't show that they have any losses. I do have losses. I try to have more than 50% winners than losses based upon the setups that I see here. But these are just two recent losses that I've taken over the last couple weeks. JP Morgan had earnings. It gapped up and went right up against the September highs there around 120 and got rejected in response to its earnings. I wound up taking a short as it was breaking down below its opening range low around 118s, if I recall. And I risked about $2 on the trade, which was the morning opening high. Oh, that was about it. That was about the low of the day there, right underneath that opening range low. And buyers stepped right back in and took it right back up over the opening range high, and took us out for a $2 loss. So yeah, that happens. I was hoping that after the 4 or 5 day run up into earnings, that maybe sellers would have been a little bit more aggressive against September highs there, and maybe even close the gap. I felt like the risk reward was there on the trade, so I took it. Plain and simple. I was wrong, and you get out of it. I'm not going to sit around and start adding to a loser unless that was my initial plan on the trade, so I got out of that one. The JNUG, this one was kind of disappointing because I had the right read on this one. It wasn't a counter trend trade like JP Morgan was, where I was basically trying to fight against the running up momentum. JNUG is the 3 times weighted gold miner ETF. And I was pretty bearish on gold going into October based upon the price action there. You can see it's almost like a bear flag pennant that was setting up there. Shows up on the TA page scans as a pullback short candidate. And I wanted getting short as it starts to roll over underneath 2-day lows, underneath 64 there. I got a short entry around 63.25. I'm risking $4 because it is one of these 3 times weighted ETFs, so it's pretty volatile there. Has an ATR of about $7 or $8. So I probably should have given it a lot more wiggle room than I should have. I gave it about half of that. And sure enough, it was looking okay, and then things started to turn around come the afternoon. And it went about $3.50 against us, and I just said, you know what, I'm not hanging around here just to take a $4 loss for the next day if this opens higher. So I just kind of headed for the exits right there on that trade for a $3.50 loss. Unfortunately, it opened lower the next day and just started plunging as I thought it was going to do. I know some people were kind enough to write back in some feedback saying they did stick it out. Again, this comes down to position sizing. Clearly I had too tight of a risk on and probably too much size on at that time for such a name that was so volatile that I wasn't able to sit with it. And again, I'm not perfect by any means of a trader. I do make errors like this, quite frequently. So sometimes I will get out of something just because I don't feel comfortable with it, yet the story is still there, and somebody else who managed that position better is riding, the rewards of the timing of the setups that were there. So It's kind of a tricky thing, I'm going to be dead honest. We're not, like I said, we're not all perfect here, and the timing can be off. And a lot of times, it has to do with your position sizing of whether or not you are truly going to be successful and ride things out a little bit longer than other people. So that's a key component. And if you listen to Trader Audio, I talk about that a lot. You can ask these guys. It's almost ad nauseum that I will talk about risk management, especially when volatility is spiking, and how important it is. And if you're struggling with trading, you have to trade smaller. Get smaller, get smaller, get smaller. If you're not struggling with trading and you're out there and you got that discipline to get in and out, well, then you can just press it all you want. And Chart Trader and Scalp Trader, they're excellent at doing that. They can go in and out, and they have very disciplined stops and motives and what they're going after. For myself, being more of a swing trader, like I said, I like to sleep at night, so I'm going to keep things relatively small and contained within my risk parameter and just kind of go for this much easier type of flow in the market there. So anyway, that's about it for, that's all I got. I think the last thing I showed, Jim, if you got that last panel there, it just goes to show you again, this just reiterates the whole risk management thing. Ted Williams, one of the best baseball players ever, basically said that, it's one of the few sports that you can play and, be wrong 70% of the time and just be considered one of the greats. And I'd say, well, you can do the same thing with trading. You can be wrong 70% of the time. I'm sure everyone has heard this before, but it really just comes down to how you keep those losses tight and how you let those winners run. If that 30% of the time you're hitting doubles and triples, and you're keeping your losses to singles, you should come out mathematically in the long run. It's a numbers game. And it's just something to keep in the back of your mind there if you go through a string of losses, or a bad day, to kind of just get over that hump a little bit and just kind of get back on track and focus on just the basics and the fundamentals. And, even if it means just hitting a single or two a few times to get back on that, get out of that slump, then so be it. So I know on this trading service, we're only as good as our last trading call. Feedback will tell you that a lot. But it's not about that. And I think if you recognize the fact that, it's a really kind of just keeping everything under control and, letting those winners run, you're going to find out that this is really just an excellent service, providing tons of ideas for everybody.
All right, Scott. Well, I do appreciate you giving a little snapshot into how you come up with trades and some of your risk parameters associated. As always, if you'd like to communicate with Scott, hit us up on that feedback, and the most important thing, leave your email if you want a response. That's the best way. I know Scott will pound the table. If you want a response, leave your email. So I encourage you to do so.